Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, December the 4th. So happy birthday to a very special person. So December the 4th, 2025. Let's go in and look and see what's happening. We had some data yesterday, guys. Let's have a quick review just of the ADP number. So everyone's trying to sort of get a sense of what's happening with the employment market. And what we can see here is that ADP yesterday actually came in negative. You see here down at minus 32,000. Now, we all understand that it's not perfectly correlated to the official sort of non-farm payrolls and employment report. But nonetheless, if you look at the 3-month moving average, you can see that the ADP number here on, let's say, a 3-month rolling average is sort of grinding downwards. And if you look at the non-farm payrolls, which of course we're still behind, you can see that in the bars here, the histogram is also going down. So it does seem that, in some general sense, without being super specific, both non-farm payrolls and the ADP private survey is sort of weakening. And you can especially see this in yesterday's data, which was for November. You can see here that most of the negativity, in a sense, was with the small businesses. So not so much the large and the medium, which is these up here, but you see this sort of orange line here. The small businesses definitely sort of under pressure. So that's not great. In terms of other interesting stuff coming out of the ADP, you can see the people who changed jobs. You see the job change. You can see that their the year-over-year change in pay in their salary actually was going down, whereas it's more stable for people staying in their jobs. So it looks as though people who either lose their jobs or decide to quit, if they do try and find another job, it may not necessarily be as well paying, which is potentially indicating a tightening labor market. The other issue here, though, let's have a look at the ISM services, which is the other data. That was a bit more mixed because the overall number was actually up a little bit, 52.6. So that was a bit higher than expected and still above the 50 level. Remember, the 50 level can, below that signals sort of contraction. Things are getting worse. Remember, it's a survey. It's a series of questions. It's not hard data, these ISM sort of numbers. But the problem here is that the new orders component went down. So that's not great looking into the future. You also look at the employment index. I mean, it ticked up a little bit, but it's still technically getting worse. So in theory, what this means is worsening, but at a slowing rate. So again, just this idea of things are not collapsing, but they are somewhat softening. And the prices, this is maybe good for the Fed. In the ISM prices, we see that the prices paid, so the inputs were a little bit down. So overall, again, difficult to draw, definitive conclusions, but what it does seem to be is that the labor market does seem to be somewhat slowing, and and overall that the economy is sort of flat in a sense, not really ripping. So and now we get some bit more data. We just actually got the challenger job cuts. So let's have a quick look at that. That just came in a few minutes ago at 7:30. I think I have that up here somewhere. So if we have a look at that, so this is so you see last time this is the challenger job cuts. Last time came in at 153,000 job cuts. So this is a number of jobs eliminated. This month, not as bad. It was actually not as bad as forecast. The survey was for about 90,000. So, I mean, it's at a glass half full or half empty situation. 73,000 cuts is not wonderful. Let's maybe see if we can see this on a comparative level there. Yeah, so you can see here, if we go back, I guess we'll allow all the cookies. They have all our information. So if you have a look at this going back, let's maybe go back 3 years. You can see here that the number was pretty stable going back 2023, 2022. It looks around about the 70, 80,000 mark. So what we just got is quite good, but with a few little spikes. So this is a choppy number. Difficult to draw too many conclusions, but definitely we're not down at the lows in the middle. So the consensus seems to be that the US job market is not creating an enormous amount of jobs, but because of Trump's aggressive immigration curbs, I guess we could say, there are definitely less sort of workers, undocumented and fully documented, coming into the US. So the pool of new available workers is diminishing. So that's keeping the job market maybe in a more balanced state than otherwise it would be. Apart from that, what we do have a little bit later in about an hour or so, we also get the initial jobless claims. Again, that's been, what's going on with all these stupid ads here? What we're getting for the initial jobless claims, if you actually look at that, expected to come in, around about 220,000 or so. And again, if we look at that, you can see just going back over a year. Okay, this is getting very, very annoying here. All these cookies. you can see here that it's still pretty low. So the initial jobless claims does seem to contradict a little bit what's happening with ADP and maybe even in the non-farm payroll numbers. So let's we have to wait probably another few weeks or a month or two to get fully caught up with the non-farm payroll numbers. But again, it looks as though the U.S. Labor market, the best I can figure out, is stable and maybe slightly weakening. We shall see. Okay, so in other news today, there was some sort of so-called sources story, both from Reuters and Bloomberg, essentially saying that the members of the Bank of Japan have been in consultations with the government over in Tokyo, Takeichi's government, and essentially, sort of agreeing that a hike, is not necessarily a problem for the economy, and so those sort of hawkish sort of stories pushing further down on the Japanese bonds. So you can see here the Japanese 10-year. This is the price, not the yield. So this is the price going down. So yields pushing higher, and you can see here, as I was talking yesterday, it broke a decisive level here. So those yields are pushing higher. Having said that, there was quite a concession built into the market in the sense that the yields were allowed to drift higher, and there was a bond auction, a 30-year auction overnight, which went quite well, but at these lower prices. So the interesting thing here is that you can see in other developed markets, let's say like the Bund, you can see the Bund is down, and also not as much, but you can look at the French bonds also down a little bit. And if we go across the US, if you look at the 10-year, not hugely, but down a little bit. So basically, those yields in the Japanese bonds are also putting upward pressure on yields across all developed market bonds, and that's going to be felt a little bit in the Japanese yen as well. So we see the yen actually up a little bit against the dollar. So the dollar overall down against quite a lot of currencies, but especially we see in the yen here, it didn't get quite up to that, sort of key level at about 159, let's call it. But obviously, the last sort of few days, the yen showing some strength here. Now at a pretty key point, because what you can see here is that we're now at the Fibonacci zone. So you can see here from this recent impulse of the 17th of October, since that sort of rejection candle there, you can see we've now reached to the 38% retracement. So, for technicians and algos, that's an important level at about the 154.7 level. And really, what needs to happen here for the US dollar bulls, if you also go back just on the downtrend, you can see here that that 50% retrace, which would be around about 153.7, would also coincide with the toppermost part of the channel, and also, excuse me, this downtrend. So this level down here at about 153.7 could be a place where the bulls, if they exist, would want to come in. That's an interesting risk reward if you like the US dollar, is to come in here. But certainly at this point, the US dollar having a bit of sort of weakness. We're also seeing that against, for example, the Australian dollar. There's been sort of a bit of a chatter that the RBA, the Reserve Bank of Australia, is a little bit concerned that the economy is doing okay, and that the inflation remains a little bit sticky. So the market is starting to price out odds of the RBA cutting any more over the next sort of 6 months or so. And just by the way, I forgot to mention that going back to Japan, talking about a potential rate hike by the BOJ in December, the market is pricing in now about 66%, so almost 2/3% chance of a hike. So still a little bit more to go. If they were to hike, you could see the yen strengthen further here down towards 153.5 or something like that. So about 2/3 priced in. And in Australia, similar kind of hawkish repricing. So you see the Aussie up against the US dollar, like a lot of currencies over the last 36, 48 hours. Having said that, if we look at the Aussie, let's put it on a weekly chart. We can see that we're at quite an important sort of downtrend. Let's have a look here. So you see overhead resistance here. So the Aussie dollar now trading at about 66 cents. But you can see here, if it were to go high, it really has to break this, quite long-term sort of a downtrend line here, right in the middle of this trading range. So this is another issue here. It's right in the middle of this trading range, which was seen going all the way back to 2022. So quite a key level here. I would say, just putting it back on the dailies, that potentially what could happen, let's see if it breaks out here. First step is going to be to get to this local high of about 67.06. If it gets up there, that would be reasonable, but really the bulls can't say that they've broken out of this shorter term range until they break above that. Although having said that, if it breaks above that, we could see we could see a little bit of blue sky, so to speak, and we could see it pushing higher. So keep in mind, I'm just going to open up here, put a little nick box on. So you see these levels here, all the way back here. You see quite important levels coming up as well. So this is the next resistance up there a little bit. Looks like we have an Australian dollar, maybe about another percent or so. But if it fails here, that's also a good place to fail. So it's going to be interesting to see what happens here, because that is definitely a place for some resistance or maybe some profit taking. Apart from that, we also see a lot of other currencies. We see the euro has been grinding higher. Nothing really particularly driving this apart from, maybe some seasonal weakness in the US. And as I say, and sort of a sense that maybe the US will be getting the Fed, a more dovish Fed chair, and a sort of the slightly weakening economy, weakening data. Talking about the Fed chair, it's interesting. Trump's comments. Trump has sort of said, "Oh, he's made his decision." But remember, a week or two ago, he said he would definitely announce that before Christmas, and now he's saying, "Oh, he'll announce it sometime in the new year," which in and of itself is not unusual. Although the rumors are going around that not Besant, I always confuse it, Hassett, Kevin Hassett, what's his name here? I've got it here. Was it Hassett? Kevin Hassett, who is the putative choice of Trump. There's been a lot of rumors going around that members of the sort of the bond market community and the banking community are not super happy, and that feedback with that choice and that feedback has drifted back towards Treasury Secretary Besant, who maybe the idea is sort of whispering in Trump's ear and saying that the market is not completely happy about Hassett just because he is perceived to be, maybe a bit of a, sort of a puppet of Trump and wouldn't push down against inflation enough. And that would be not well received by the bond market, which of course would put upward pressure on those yields and on the mortgage, on mortgages. And we know that both Trump and Besant are very keen to get long-term rates down. Now, could they get that down by doing QE, by buying bonds, by issuing less long-term bonds? Absolutely, they could pull on those levers. But if we consider that there is some kind of affordability crisis in the UK and increasing fragmentation in, UK, in the US, in US consumers, and the midterm elections coming up at the end of 2026, could it be that Trump, his political instincts could kick in, and maybe he'll make a sort of a compromise and come up with a candidate, maybe someone like Waller or Kevin Walsh, who is not as who is perceived to be not so much as a puppet and maybe less dovish than someone like Hassett. So it's going to be quite interesting to see just around Christmas and into the new year whether in fact Trump backpedals a little bit on that. If that's the case, we could see the bond yields in the US, actually, especially on the long end, going down a little bit, because you see here we're at quite key levels here at about 4.7, 4.75 here on the 30-year, and if you look on the 10-year here, you see just hovering around this 4% level. So really, the bond market, in order for those longer term yields, the 10 and the 30-year, to drift back 10, 15, 20 basis points or so, the bond market will have to be convinced that the incoming Fed chair, whoever he or she may be, will be sort of serious about fighting inflation, which at the end of the day still remains sticky. And if we look at core PCE inflation tomorrow, we can have a look at that just on the calendar. Let's see if my stupid cookie things wants to come up. So we can see here, if we look at what is going on here? This is very weird. Anyway, if we look at the PCE tomorrow, we can see that sort of annualized, it's still at 2.7, 2.8%. So although one can say it's not exploding above 3 or 4%, the reality is that it's definitely not, towards the Fed's lower bound around 2%. So that it remains sort of sticky. And that's going to be, the bond market probably would prefer someone at the Fed who is willing to fight that a little more. Okay, so just finally, not a huge amount going on today. Let's just have a quick look. You see the gold taking a little bit of a pause here, although certainly nothing, this is not any kind of negative pullback. If I just throw a few moving averages on, you can see that gold, very, very happy above all the moving averages. We look at silver as well. Again, silver taking a bit of a pause. As I say, if you do this sort of Fibonacci sort of profit-taking extended measured move, you see that it is sort of getting into the extended moves here. But again, well above all the moving averages, no technical damage at all being done. Maybe what's just pulled this back a little bit. If you look at the gold-silver ratio, you can see here, as I was pointing out, that the key level around about 73. You see this key level going back to mid 2024. It's unusual for or has been unusual for that to go low, and that's a bit of a key level. I mean, it can of course go lower, but you see that it's quite a strong level here. If we pull this all the way going back there, you can see that in order to break that, that would have some sort of meaningful, well, it would be a little bit meaningful, and that would be really be signaling an underperformance of gold to silver. And just to put on a historical context here, that's where we are. So silver, all of this means that gold has underperformed. This whole thing here going all the way back from April of this year, gold has underperformed on a relative basis to silver. So maybe that's time for a little bit of a pause here, potentially. And that doesn't necessarily mean that either of those precious metals will go down, but it just could mean that, relative to gold, silver maybe just takes a little bit of a break here. Because we also see, if we look at copper also doing quite well. But again, just at a bit of a sort of a triple top sort of level here, although it does seem to be breaking higher. So maybe copper will pull back here a little bit to a short-term fib zone and can push up a little bit higher. In terms of the equities, not a huge amount to say. The volatility, VIX is down at about 16, again indicating about a 1% move per day. So that's quite contained. All things considered, that is sort of a bit of a tailwind for the equities. And we see the ES here not doing a huge amount, but doing absolutely nothing wrong. Moving averages starting to flatten out along the highs. Probably just waiting for a bit of information on the PCE numbers, which we get tomorrow, and then of course we get the Fed. We get the Fed next week, so maybe the equities just want to sort of hover around the top here and wait until we start to get a bit more economic data and some sort of further direction from the Federal Reserve. Final thing which just want to mention, just keep an eye on Brazil. Of all the global equity markets, Brazil just continues to rip higher. I mean, look at this, just even on this very short-term measured move, as I was saying yesterday, could push up higher. And again, a couple of green candles the last couple of days. All dips are being bought here. Moving averages, very powerful chart, similar to the Kospi over in Korea. So just that's one to be in. Hopefully, you're already in that. Okay, guys, I'll leave it there. Have a great day, everyone, celebrating birthdays, and I'll be back tomorrow with the macro snapshot. Thank you, and have a great day.